Let's look at the data. Forget the memes, forget all the hype. Today, we are cracking open the playbook. We're going to break down the mechanics of a short squeeze by analyzing the raw, quantitative signals, the actual data signatures that can flag these explosive market events before they even happen.
This right here, this is the number that matters. 210%. Now, that is not a guess, it's a data signature. It represents the statistically proven jump in the probability of a short squeeze when a very specific observable set of market conditions are met. And that is the anomaly we're hunting.
And that's really the crucial point, isn't it? We're cutting through all the social media noise to look at the market's internal machinery. We're focused on the statistical indicators that show us a stock is coiling up for a major move. This is all about identifying high-probability setups, pure and simple.
All right, Section 1, Anatomy of a Squeeze. To spot the anomaly, you first have to understand the machine. So what exactly is a short sale, and how does it load the spring for a squeeze? Let's get into it.
Okay, so let's be really clear about this. Short selling isn't inherently evil. It's actually a critical market function. It lets participants express a bearish view on a stock, which in turn helps with price discovery. At its core, it's just a bet that a stock's price is going down. But it is a bet that comes with a unique and often absolutely brutal risk.
So when the short thesis is right, the trade is actually pretty clean. You borrow shares, you sell them high, you wait for the price to drop, and then you buy them back low to return them. That difference, that's your profit. Simple enough. But what happens when that thesis is dead wrong?
Just look at the asymmetry of risk here. It's wild. When a short works, your profit is capped, right? Because the stock can only go to zero. But when it goes against you and the price starts to climb, well, you're forced to buy back those shares at higher and higher prices to cover your position. And since a stock's price has no theoretical ceiling, your potential losses are quite literally infinite. This is the mechanical trap that fuels a squeeze.
So how does this trap actually build into a predictable event? Well, some really interesting research from Mendel University pinpointed the specific data points that act as accelerants. This is where we find the data signature of that coiled spring right before it snaps.
The study basically isolated two statistically significant predictors. First, you've got high short interest. Think of this as the fuel, a massive pool of potential forced buyers. And second, you have a sudden spike in investor attention. This is the spark, the catalyst that's going to ignite all that fuel.
Now, the data shows that even with a kind of moderate short interest of just 7 to 17%, the probability of a squeeze already jumps by 78%. What that tells you is that the system is already under a lot of pressure. The market is highly sensitive to bearish sentiment when other factors start to align.
But this is the critical threshold. When short interest pushes past that 17% mark, the probability of a squeeze absolutely skyrockets by 210%. This is the data signature of the coiled spring. The pressure on the short sellers becomes immense, and the situation is now highly unstable.
And this quote from the researchers themselves just nails the core thesis. Short squeezes are not random. They are phenomena that can be anticipated. With the right observable signals, these events aren't a surprise at all. They are a logical conclusion.
To put that 25% threshold in perspective, just look at GameStop. At its peak, short interest hit an unbelievable 140% of its public float. I mean, this wasn't just beyond the critical threshold, it was in a completely different stratosphere. A squeeze wasn't just probable, at that point it was a mathematical certainty just waiting for a spark. But high short interest alone isn't the whole story. There's a crucial counterweight we have to talk about: institutional ownership. This is the stabilizing force, the so-called smart money, that can often prevent a squeeze from ever even igniting.
The same research found this really powerful countersignal. For every single 1% increase in institutional ownership, the probability of a squeeze decreases by almost 6%. So why is that? Well, it's because these large holders provide a deep pool of liquidity and stability, and they absorb the very volatility that a squeeze needs to thrive.
Smart money isn't a monolith. Institutions can be the short sellers, like Melvin Capital was, but they can also be the long holders, like BlackRock, who actually profit from the surge. Crucially, their massive presence tends to absorb volatility and provide liquidity, making it much harder for a purely retail-driven squeeze to gain traction.
So, let's put it all together. Bull versus bear. This is how you read the complete data signature for a potential squeeze. Okay, so here's the playbook.
The bull case for a squeeze really ignites when you see short interest above that 17% critical threshold. You combine that with a surge in investor attention and, crucially, low institutional ownership. That lack of a stabilizing force is key. The bear case, well, it's the exact inverse. Low short interest, heavy institutional ownership providing stability, and a real lack of social media chatter. This is your data-driven checklist.
Ultimately, the data can show you the high probability setup. It can absolutely identify that coiled spring. But spotting the setup, that's only half the battle. The other half is navigating the insane volatility that comes with it and managing your own risk. And that part, that's on you.
And I have to be crystal clear here. This analysis is for educational purposes only. It is based on historical data, and that data changes in an instant. This is not financial advice. You must always do your own due diligence.
We are tracking these flows in real time. While you analyze the next move, check out the tools in the description. Sign up for Public to get $20 in free assets, check Webull for that BTC promo, or look into NBDA on Moomoo. The links are down below. And hey, like and subscribe for more deep dive analysis. Stay disciplined, stay liquid.